Exercise 5. Use the following adjusted trial balance of Resource Trucking Company to prepare Resource Trucking Company's classified balance sheet as of December 31, 2011. The net income for the year is $31,366, and we're reminded to be sure to list the assets and liabilities in order of their liquidity. Now, not that we don't trust the author, but let's just verify the $31,366. If we look at our income statement accounts, our one revenue account, trucking fees earned, and the four expense accounts, we can quickly combine those values to determine net income. $126,000 in revenues minus our four expenses, $21,924, $57,218, $5,000, and $10,492. Net income is in fact $31,366. So now let's move on to prepare the classified balance sheet. A classified balance sheet is still a balance sheet. Its format, total assets, equals the sum of total liabilities and equity. What makes a classified balance sheet different are the subtotals within assets and liabilities. Within the assets section, we differentiate between current assets and non-current assets. Non-current assets include long-term investments, plan assets, and intangible assets. What makes an asset current is the fact that it will either be converted to cash or used within 1 year or one operating cycle, whichever is longer. Resource Trucking Company, like most companies, has an operating cycle that's less than 1 year. So for our purposes, the difference between current and non-current is a 1 year cutoff. Similarly, we'll segregate our liabilities into two categories: current liabilities, those that will be payable within the year, and long-term liabilities, those that are payable beyond the current year. Now let's prepare the classified balance sheet for Resource Trucking. When we look at the assets, cash, accounts receivable, and office supplies will all either be converted to cash or used within the current year. Trucks, accumulated depreciation on the trucks, and land will not be consumed within the year. So we have 3 current assets and 3 non-current assets. On the classified balance sheet, we list cash, accounts receivable, and office supplies as current assets, and then we calculate the subtotal, total current assets, $35,610. Within the current assets, we've included them in order of liquidity. Cash is already available to help meet our obligations. Accounts receivable will be collected probably within the next 30 days, and then that cash will help us meet our obligations. And office supplies are not liquid. We're not really going to use them to satisfy the debts of the company, but we're going to use them up within the year. The remaining 3 assets, our non-current assets, are plan assets. Plan assets are tangible assets that are used actively in the operation of the business. Within plan assets, our non-current assets, we list the trucks, the $165,000 cost of the trucks, less the balance in accumulated depreciation on the trucks, the amount that has been depreciated over the life of the trucks as of December 31, 2011. Accumulated depreciation is a contra asset. Its balance is always listed directly below the asset it's intended to reduce, in this case the value of the trucks. And then we include the subtotal, the book value of the trucks, $131,010. The next plan asset is land. Land is non-depreciable. We include its cost. We total our plan assets, $178,010, and then we add total current assets and total plan assets, gives us total assets, $213,620. Now we turn our attention to our liabilities. When we look at the adjusted trial balance, we have 3 liabilities: accounts payable, interest payable, and long-term notes payable. Accounts payable and interest payable are both due within the current year. We will list those as current liabilities. Long-term notes payable, as its name would indicate, is a long-term liability. That is not payable within the current year. We'll list it as a long-term account. So our liabilities include accounts payable, interest payable, both of which are current. We do a subtotal, total current liabilities, $21,400. Then we list our long-term liability, long-term notes payable, $61,000. Total liabilities, $82,400. And our equity includes the owner's capital account. Now there are several ways to determine RESO's capital. The first and easiest way would simply be to say total equity is the difference between total assets and total liabilities. So if we take total assets $213,620 and subtract total liabilities $82,400, we determine that Riso's capital account should be $131,220. This would complete the accounting equation, total assets equals total liabilities and equity. But what I'd like to show you now is a way to check the equity balance. We start with the capital balance, $115,854. We add net income, $31,366, and subtract Riso's withdrawals. That confirms that Riso's capital balance is $131,220.